On January 23, 2025, President Donald Trump made a significant impact on the digital asset landscape by signing an executive order titled Strengthening American Leadership in Digital Financial Technology. This marked a notable pivot from his earlier skepticism towards cryptocurrencies during his first term. The new order aims to place the U.S. at the forefront of the digital asset sector and is anticipated to stimulate growth in the burgeoning $200 billion digital asset market. Key developments. 1. Repeal of SAB 121. The executive order led to the immediate repeal of the SAB 121 rule by the Securities and Exchange Commission (SEC). This rule had imposed significant restrictions on banks and financial institutions, making it difficult for them to offer crypto custody services. Its repeal is expected to encourage greater participation from regulated financial institutions in the cryptocurrency ecosystem. 2. Formation of a working group. The executive order establishes a President's Working Group on Digital Assets tasked with reviewing existing regulations affecting the digital asset sector and proposing a comprehensive federal framework. This group is expected to enhance regulatory clarity and foster innovation in the digital financial technology space. 3. National Digital Asset Stockpile. One of the more intriguing elements of the executive order is the proposal to develop a national digital asset stockpile which may include cryptocurrencies seized through law enforcement. This indicates a significant governmental interest in accumulating digital assets, potentially positioning the U.S. as a major player in the global cryptocurrency market. For pro-crypto administration, the executive order signals a broader pro-crypto policy shift within the Trump administration. Key figures in Trump's team such as venture capitalist David Sachs and SEC Commissioner Hester Peirce are known advocates for cryptocurrency, reinforcing the administration's intention to create a more favorable regulatory environment for digital assets. 5. Market response. Following the executive order, Bitcoin saw a notable surge, reaching approximately $109,000 shortly after Trump's election victory. This jump illustrates the immediate impact of the new policies on investor sentiment and market dynamics. Political context. Trump's pro-crypto stance can be traced back to significant financial support from the cryptocurrency industry during his 2024 campaign. The digital asset sector contributed heavily to his campaign, with many executives and companies rallying behind him as a response to the previous administration's regulatory approach. This shift in political support reflects a broader recognition of the importance of digital assets for innovation and economic development. Industry reactions. The repeal of SAB 121 has been widely celebrated within the industry. Major players like Coinbase and Binance have expressed optimism about the potential for enhanced clarity and growth opportunities in the digital asset sphere. The sentiment among industry executives is that the new regulatory landscape will encourage innovation and participation from both retail and institutional investors. However, Trump's administration has faced criticism, particularly concerning the launch of meme coins associated with his family. Critics argue that the involvement of political figures in such ventures raises ethical questions and undermines the legitimacy of the cryptocurrency space. Concerns have been voiced about potential conflicts of interest and the implications of using political influence for personal gain. Conclusion. In summary, Trump's executive order represents a significant pivot towards embracing cryptocurrency and digital assets in the U.S. The combination of regulatory relaxation, the establishment of a working group, and a focus on innovation positions the country to potentially reclaim its status as a leader in digital financial technology. While the immediate effects on the market have been positive, ongoing scrutiny of ethical practices and the potential for regulatory overreach will be crucial as the digital asset landscape continues to evolve. The coming months will likely provide further insights into the administration's plans and the broader implications for the cryptocurrency market. The content surrounding President Donald Trump's executive order on January 23, 2025 and the subsequent repeal of SAB 121 by the SEC presents several counterintuitive insights regarding the evolving relationship between politics and cryptocurrency. 1. Political shift in financial incentive. One of the most striking aspects of Trump's new executive order is the dramatic shift from his previous skepticism towards cryptocurrencies during his first term. The fact that Trump's pro-crypto stance aligns closely with significant financial contributions from the crypto industry during his 2024 campaign raises questions about the motivations behind political decisions. It suggests that financial backing can significantly influence policy direction, which might be seen as a conflict of interest, particularly given the historical context of Trump's earlier criticism of crypto. This counterintuitive shift, from skepticism to advocacy, challenges the perception of political consistency and the genuine motivations behind such changes in stance. 2. Meme coins and ethical concerns. The introduction of meme coins $Trump and $Melania associated with Trump's family has generated skepticism among crypto enthusiasts and industry executives. The fact that Trump is capitalizing on meme coins, which are often seen as speculative and lacking intrinsic value, contrasts sharply with the serious narrative of establishing a national digital asset stockpile. This dichotomy highlights a troubling duality in Trump's approach. While promoting the legitimacy of cryptocurrencies, he simultaneously engages in activities that could undermine that credibility. The ethical implications of a sitting president profiting from meme coins raise significant concerns about the integrity of the crypto space and the potential for exploitation. 3. Expectations versus reality of regulation. The repeal of SAB 121 was celebrated as a victory for the crypto industry, reducing the regulatory burdens on financial institutions. However, the expectation that this would lead to an immediate and unencumbered growth of the crypto market might be overly optimistic. The reality is that while regulations may ease the underlying volatility and risks associated with cryptocurrencies remain. The rapid increase in Bitcoin's value following Trump's election might not reflect a sustainable trend but rather a speculative bubble driven by market sentiment influenced by political events. This situation challenges the assumption that favorable regulation will directly lead to stable and consistent growth in the crypto market. 4. Contradictory priorities. Trump's focus on creating a national digital asset stockpile potentially sourced from seized cryptocurrencies contrasts with the broader goals of fostering innovation and economic growth in the digital asset sector. The idea that the government would stockpile digital assets typically associated with illicit activities is counterintuitive to the narrative of legitimizing and mainstreaming cryptocurrencies. This move could further entrench the perception of cryptocurrencies as tools for criminal activity, complicating efforts to promote their adoption for legitimate economic purposes. 5. Market response versus political reality. The immediate positive market response to Trump's executive order and the repeal of SAB 121 may suggest a seamless transition to a pro-crypto environment. However, the market's volatility and susceptibility to external shocks make it difficult to predict long-term trends. The notion that political changes can lead to stable financial outcomes overlooks the complex interplay of market psychology, regulatory environments, and broader economic conditions. This discrepancy between market optimism and the unpredictable nature of cryptocurrencies emphasizes the need for caution in interpreting short-term market movements as indicators of sustainable growth. 6. Consumer protections versus industry interests. While the executive order outlines protections for individuals and companies in the crypto space, it also raises concerns about potential regulatory capture, where industry interests may unduly influence policy decisions. The emphasis on protecting developers and miners from persecution may prioritize industry profits over consumer protections, which could lead to regulatory environments that favor established players at the expense of new entrants and consumers. This potential imbalance challenges the narrative of a fair and equitable digital asset market and raises questions about who truly benefits from the new regulatory landscape. In conclusion, the dynamics surrounding Trump's executive order and the crypto market reflect a complex interplay of political motivations, market behaviors, and ethical considerations. The counterintuitive elements present in this scenario challenge conventional wisdom about the relationships between regulation, market stability, and political influence, suggesting a need for a more nuanced understanding of the evolving landscape of digital assets. In the recent executive order signed by former President Donald Trump on January 23, 2025, there are several critical aspects that may be overlooked by many observers, yet they bear significant implications for the future of cryptocurrency regulation and the broader digital asset market. Here are some key overlooked points along with their significance. 1. Establishment of a national digital asset stockpile. The order outlines the intent to create a national digital asset stockpile which could be sourced from cryptocurrencies seized through law enforcement actions. This element is pivotal because it indicates a shift in how the U.S. government views digital assets, not merely as speculative investments but as strategic national assets. The potential accumulation of a government-held reserve of digital assets could alter market dynamics and investor sentiment significantly. It raises questions about how these assets will be managed and the implications for market stability and regulation, potentially leading to a new era of government involvement in the crypto space. 2. Repeal of SAB 121 and its broader implications. The repeal of SAB 121, which previously imposed significant regulatory burdens on financial institutions wishing to offer crypto custody services, is celebrated as a win for the industry. However, the broader implications of this repeal are often understated. It signals a complete overhaul of the U.S. regulatory environment for cryptocurrencies, which could lead to a rapid influx of institutional investment. The easing of these regulations could also lead to increased participation from banks and financial institutions that had previously been hesitant to engage with digital assets due to the complexities introduced by SAB 121. 3. Influence of campaign contributions from the crypto industry. Trump's campaign received substantial financial backing from the cryptocurrency sector, which played a critical role in his policy shift. This relationship raises ethical questions about the influence of money in politics, particularly as it pertains to regulatory frameworks. The speed with which the new administration has enacted pro-crypto policies suggests a direct correlation between campaign contributions and regulatory outcomes. This intersection of finance and policy could set a precedent for future administrations, emphasizing the importance of transparency and accountability in political contributions. 4. The role of key figures in the administration. The appointment of pro-crypto figures within Trump's administration, such as David Sacks and Hester Peirce, is significant. Their influence on policy direction indicates a shift toward a more favorable regulatory landscape for cryptocurrencies. However, the potential for bias and conflicts of interest in policymaking is a critical concern. The emphasis on innovation should not overshadow the need for consumer protection and the prevention of fraud, especially in light of the recent controversies surrounding meme coins tied to Trump's family. 5. Ethical concerns regarding meme coins. The introduction of meme coins associated with Trump, including $Trump and $Melania, has sparked significant debate within the crypto community. While these coins may symbolize the growing intersection of politics and cryptocurrency, they raise alarms about market integrity and the potential for exploitation. Critics argue that such ventures could undermine the legitimacy of the cryptocurrency industry, drawing parallels to scams and schemes that have plagued the sector. The ethical implications of a sitting president engaging in such activities are profound, as they challenge the boundaries of public service and personal profit. 6. The lack of direct mention of Bitcoin. Despite the emphasis on digital assets, it is noteworthy that the word Bitcoin was not mentioned in the executive order. This omission may reflect a strategic decision to focus on broader regulatory frameworks rather than specific assets. However, it could also indicate a reluctance to fully embrace Bitcoin as a viable asset class within the national financial strategy. This lack of specificity may lead to uncertainty among investors and could affect Bitcoin's role in the overall digital asset landscape moving forward. 7. The impact on market sentiment and investor behavior. The immediate market response to Trump's election and the signing of the executive order has been positive, with Bitcoin's value experiencing significant increases. However, this volatility underscores the fragility of market sentiment heavily influenced by political developments. The rapid fluctuations in asset values could lead to speculative bubbles, emphasizing the need for careful regulatory oversight to ensure market stability while fostering innovation. Conclusion. In sum, while the executive order signed by Trump signifies a significant shift in the U.S. government's approach to cryptocurrencies, it is essential to scrutinize the underlying implications of these changes. The establishment of a national digital asset stockpile, the repeal of SAB 121, and the influence of campaign contributions are all elements that merit closer examination. Furthermore, ethical concerns surrounding meme coins and the lack of direct references to Bitcoin raise important questions about the future direction of cryptocurrency regulation in the United States. As the digital asset market continues to evolve, these overlooked aspects will play a crucial role in shaping both policy and investor behavior in the years to come. 1. Pro-crypto shift in regulatory environment. President Trump's executive order signifies a pivotal change in the U.S. government's stance towards cryptocurrencies. This contrasts sharply with the previous administration's approach, which was marked by skepticism and strict regulations. The repeal of SAB 121 by the SEC alleviates previous burdens on financial institutions, allowing them to engage more freely in crypto custody services. This regulatory clarity is expected to foster greater institutional participation in the digital asset market, potentially leading to significant growth and innovation within the sector. 2. Establishment of a national digital asset stockpile. The executive order outlines plans for creating a national digital asset stockpile, primarily sourced from cryptocurrencies seized by law enforcement agencies. This initiative highlights the government's proactive interest in accumulating and managing digital assets, which could position the U.S. as a formidable player in the global crypto landscape. Furthermore, the emphasis on protecting blockchain developers and miners from regulatory overreach indicates a commitment to nurturing the digital asset ecosystem. 3. Influence of political contributions on policy. The financial backing received from the crypto industry during Trump's 2024 campaign played a crucial role in shaping his administration's pro-crypto policies. Significant contributions from crypto investors and companies reflect a strategic alignment between political funding and favorable regulatory outcomes. This relationship raises ethical concerns regarding the potential for regulatory capture and the influence of money in politics. As the crypto industry seeks to navigate its regulatory landscape through strategic alliances. For ethical implications and market integrity, while the executive order is celebrated by many in the crypto space, questions arise regarding Trump's involvement in the launch of meme coins associated with his family. Critics argue that such ventures could undermine the credibility of the broader cryptocurrency industry, especially as they are linked to market speculation and potential scams. This situation emphasizes the need for ethical considerations in public policy, particularly when political figures engage in activities that may conflict with their regulatory responsibilities and impact market integrity. 1. The gold standard and the Bretton Woods system. The transition from the gold standard to the Bretton Woods system after World War II illustrates a significant shift in monetary policy and international finance. The gold standard had provided a stable currency framework but limited flexibility in monetary policy. The Bretton Woods Agreement established a new international monetary system with fixed exchange rates linked to the US dollar, which was convertible to gold. This shift was driven by the need for economic recovery and stability in the post-war era, similar to how the recent executive order aims to reshape the landscape of digital assets and cryptocurrency regulation. 2. The New Deal and financial regulation. In the 1930s, Franklin D. Roosevelt's New Deal represented a fundamental transformation in government policy towards the economy, particularly in financial regulation following the Great Depression. The establishment of the Securities and Exchange Commission (SEC) and the repeal of the Glass-Steagall Act are comparable to the recent repeal of SAB 121 by the SEC. Both instances reflect a governmental response to economic dislocation and a move to restore confidence in financial systems, indicating a proactive approach toward fostering innovation and economic growth. 3. The dot-com boom and the SEC's role. The late 1990s saw a massive expansion of the internet and technology sectors, leading to the dot-com boom. This period was marked by regulatory adjustments, including the SEC's efforts to provide a more conducive environment for tech companies to go public. Similar to the current climate for cryptocurrencies, the dot-com era involved balancing innovation with regulatory oversight. The SEC's evolving stance during that time parallels the recent shift in regulatory approach towards cryptocurrencies, with a focus on encouraging growth while attempting to mitigate risks. The landscape of cryptocurrency and digital assets is poised for significant transformation in the coming years, particularly in light of recent developments surrounding President Donald Trump's executive order aimed at strengthening American leadership in digital financial technology. With the repeal of SAB 121 and the establishment of a supportive regulatory environment, the digital asset market is expected to experience robust growth, potentially reaching heights unseen before. Here are some predictions for the future. 1. Market expansion. The digital asset market, currently valued around $200 billion, is likely to expand rapidly. With Bitcoin's recent surge past $100,000 and a favorable regulatory environment, experts predict it could reach new all-time highs, potentially hitting $225,000 or more within 2025. This optimistic forecast is fueled by increased institutional adoption, as banks and financial institutions seek to integrate digital assets into their offerings. 2. Regulatory clarity. The establishment of a working group to propose a federal regulatory framework for digital assets will likely lead to clearer guidelines for industry participants. This clarity will not only encourage institutional investment but also foster innovation in the sector. As regulations become more defined, new financial products linked to cryptocurrencies, such as ETFs and futures, may emerge, attracting a wider range of investors. 3. Institutional adoption. As the regulatory barriers diminish, major financial institutions are expected to increase their participation in the crypto market. Banks that previously hesitated due to strict regulations may begin offering crypto custody services, trading, and investment products, further legitimizing the market. This transition could see traditional investment firms